Last year, we sold one of our Smoky Mountains Airbnbs. It was a tough decision, but I'm gonna warn you with things that you should think about in your markets, share with you why we sold and what we learned. I am currently an owner of 11 short-term rentals, 2 of which I own by myself and 9 others with partners. These 11 properties should do over $1 million in revenue this year, and I also co-host properties for clients that will make hundreds of thousands more. I'm the co-founder of BNBCalc, the premier software for analyzing rental deals and sharing branded reports. I have personally helped folk buy properties that cash flow between $1,000 and $18,000 a month. I've also helped folk launch co-host businesses and quit their jobs. However, I've learned a lot over the years doing this and have even sold properties, and honestly, those properties have helped me today launch some of my strongest ones. So, by watching this video, you will understand how things have changed in the short-term rental game in the last few years and reasons for maybe selling existing properties, and also things to be thoughtful about when buying new ones. And guys, I totally get it. When you have bought a property and invested not only money, but also a lot of time and energy into it, then it hurts to sell. Also, for new investors, hearing stories like this might make you reluctant to buy, and I totally get it, but please stick with me because I actually think this might help you think about what to look for not just today, but into the future. So I'm gonna do the following. I'm gonna share why we bought the property in the first place, exactly how much it made over the last few years. Then I'm gonna go over how the market dynamics in this area and the entire Airbnb market has changed. I'm gonna share what ultimately made us want to sell. And then I'm gonna talk about what I look for today and think about when buying in order to not run into the same issues as previous deal. So first, why did we buy the Smoky Mountains property in the first place? First, I want to take you back to when I started my short-term rental journey on a lake on the North Carolina and Virginia border. I actually started a boat rental business at that lake and got into property management and investing through clients of my boat rental business. We initially scaled at this lake to 4 owned properties and 4 managed to go along with our 7 boat rental fleet. Homes on this lake appreciated like crazy in 2021, 2022, which was good for us and our clients because we owned several, but also bad because we couldn't buy any more. Myself and my partners started looking at new markets to buy, and one of the ones we selected was the Smoky Mountains. So for those of y'all who aren't familiar with the Smokies, it is that mountain region alongside the North Carolina and Tennessee border. I would personally define it as anywhere within an hour or so drive of the Great Smoky National Park. The Tennessee side of the mountain range is probably more famous as it has towns like Gatlinburg and Pigeon Forge, with tons of tourist attractions like Dollywood. The Great Smoky Mountains National Park is actually the most visited national park in the US with over 12 million annual visitors. There was a lot of hype at this time, in 2021, 2022 on the Tennessee side of the Smokies, but we were some Carolina guys and we wanted to build an operation on the North Carolina side. We also thought that there had been a massive run up in appreciation and hype in Gatlinburg and those surrounding areas in Tennessee. So we thought the North Carolina side was better value and had room to grow. I was also in Florida at the time, setting up properties there, and my partners were willing to do the setup in the mountains of North Carolina. So for the first house we bought in the Western North Carolina Smokies, we wanted to do it with as little cash needed as possible. An opportunity presented itself to buy a small cabin, completely turnkey, with the furniture included for around $430,000. Closed on the house in November of 2021 on a house in Maggie Valley, North Carolina. So I want to talk about that specific location. Maggie Valley is in the Cataloochee Valley and is one of the more trafficked tourist towns on the North Carolina side of the Smokies. We thought that the market would have lesser seasonality, meaning we'd have more year-round traffic because of the nearby Cataloochee ski resort. We were sort of right with this assumption. However, we had an unforeseen variable hinder our ability to get winter bookings, which I'm going to talk about later. So when we were initially looking there in Maggie Valley, there was about 82 bedroom cabins in that area. The top ones were doing almost $90,000 a year in revenue, and we thought we could be one of the top performers given there weren't a lot of professional operators in the area, and everybody's photos and listings frankly looked bad. So for the house we found, our view was great. We did add a hot tub and fire pit. Other than that, didn't have to really do anything, and we launched it. And things went well. Our first guest stayed with us December of 2021 at Christmas for $500 a night, and that pretty much covered our first month's mortgage payments. So you might be wondering, how did we get financing? We actually got a commercial DSCR, debt service coverage ratio loan, through a local bank. The bank loaned directly to our LLC, and myself and the other investors of the deal were members of this LLC. We got a 5-year balloon with a 20-year amortization schedule at 3.7% interest. You might be wondering, what the heck does that mean? So let me explain. So one thing to note is we did not have a fixed rate loan. A fixed rate loan means the loan would be the same interest rate for a long time. A balloon payment means the loan is due in its entirety at the 5-year mark. So after 60 monthly mortgage payments, we'd either need to have sold the house or refinanced the loan. Initially, that 3.7% interest rate was awesome. However, rates started going up a couple months after getting the house, which affected our long-term plans. So you might ask, why didn't we get a 30-year fixed rate mortgage to begin with? Well, we were a band of 24-year-olds buying the property, and frankly, we did not have too many options. The 30-year fixed rate options were closer to 6%, so we went with the lower initial rate. This loan also didn't have points at closing, and the lower closing costs were super important to us. So we bought the house with this balloon loan. How did it actually perform? Well, the first year, it actually did very well. Not only did we hit our expectations, but we actually surpassed them. I credit my partners for doing a great job with the photos, marketing, adding some standout amenities like the hot tub and fire pit. We did around $85,000 in revenue in its first year, and we had one of the top performing 2-bedroom properties in the market, which leads me to our next point. How did the market dynamics in this area change? As well as how did they change for the entire Airbnb market? So we had a smaller property, and we did the investment because we wanted to go with as little cash out of pocket as possible. I think our initial cash investment was the $86,000 down payment, 20% down payment, and about $15,000 for the amenities, hot tub, fire pit. However, a lot of folk at this time wanted to get into the game, and they probably had similar considerations to us. The Tennessee side of the Smokies had gone relatively expensive at this point, so a lot of folk came into the North Carolina Maggie Valley area. The supply of 2 to 3 bedroom listings almost doubled in about 2 years. And this supply itself was no longer folk taking iPhone pictures. The operators and listings were a lot better than the previous supply. And now for the demand side, the market had a massive demand increase during COVID, and the market revenue was at all-time highs. In 2023 and 2024, the demand didn't actually go down, however, it stayed flat. So flat demand increased with doubled higher supply, put pressures on the prices we could charge. Whereas 2022 was a superb year, 2023 was shaping out to be, for all sakes and purposes, a good year. The property was likely to perform closer to our initial expectations of being in that $70,000 to $80,000 revenue range. This particular property was one of the smallest properties in our portfolio. And at around this time, we decided really only to expand to larger homes. We did that because we saw the performance of the larger properties didn't seem to be as affected as the performance of the smaller properties. So I believe that there was a lot of smaller properties being added nationwide, which makes sense, frankly, because smaller homes are less expensive. The cost to furnish is less, as there was less square footage, and there's, frankly, more of them already built. So we started just witnessing not necessarily outperformance by bigger properties. Like, bigger properties weren't doing better and better year after year, but potentially just more defensibility against new inventory. Recently, I've heard a lot and seen statistics from sites like Airbnb, whereas bigger properties have grown in demand and not seen the same supply increases nationwide over the last few years as smaller properties. And, people are certainly onto this. However, it just takes a lot more money to go big. So I am not as worried about what I'm calling the mega properties we're adding to our portfolio today, facing these same supply issues. If you actually look at the subsegment of 5-bedroom plus listings in the same Maggie Valley market, the revenue of that market segment actually kept going up past 2022. My hypothesis for that is that families wanted to travel by themselves during COVID, so they wanted 2 to 3 bedroom houses and not a hotel. And then after COVID, they wanted to travel with big groups and other families. So I expect this trend to continue unless we have some sort of pandemic or other bad thing like that happens. Make sure to subscribe as I share videos showing the types of properties we are buying today and how we're setting them up and marketing them to outperform. So the macro market factors certainly were important, but here are really the reasons we decided to sell. The first reason is just going to be opportunity cost. At this point, we had deals that were making more elsewhere, even at higher interest rates. Also, appreciation is such an important part of the investment. In many cases, it's going to be the most important part. And the home had already appreciated in value. And honestly, we didn't really expect for this appreciation to continue because we saw small cabins being built around the town being done really well. I'm a huge proponent of appreciation as it's literally an exponentially compounding aspect of your investment. For this property, we did not feel like the argument for appreciation was really that strong from a market dynamic standpoint. It was a small house that had already been renovated, so we couldn't really add value at this point to increase its value. I do believe the Smokies as a whole will go up in value over time as Charlotte, Asheville, Nashville, and the other surrounding feeder cities keep growing. So yes, it will likely go up in value over time, but maybe not by as much as some other investments we have in our portfolio. For example, we own several lake houses that are right outside the Triangle region of North Carolina. The Triangle is booming and they aren't building new lakes. These houses have appreciated a lot and I think will keep going up even if other markets plateau or go down in value. Second major factor, this particular property has some logistical issues because it was literally on the top of a mountain. It took probably 10 minutes to get from the main road to the house. And when winter storms hit, which they did, the road to it was sketchy. Out of an abundance of caution, we would often block the home in January and February. This certainly hurt our revenue numbers and just created some headache for my partners who managed the home. I think the biggest factor was just the uncertainty surrounding the refinance. After 5 years, we would have paid off a good bit of the principal on the loan, especially because it was a 20-year amortization schedule, which meant a quicker payment schedule and more principal pay down than a typical 30-year mortgage. However, we had no clue what the picture would look like when we needed to refinance in 2026. And honestly, it is March of 2025 right now, and I don't have a crystal ball to tell you what rates are gonna look like a year from now. So I'm expecting it to be around 7%. And we actually have another house with the same loan where we are prepaying principal a few $100 a month, so that if we were to refinance at 7%, then our mortgage payment will stay the same. However, for this particular house, there wasn't enough cushion in the cash flow to be prepaying the mortgage. So what I'm gonna do right now is I'm gonna use BNBCalc and I'm gonna actually show you the numbers on the deal. And then I'm gonna walk you through the math on the refinance and how we thought and ultimately what led us to sell. So I plugged in the property here. It was a 3-bedroom, technically a 2-bedroom, 2-bath. However, there was an additional room. Actually, they took part of the deck and turned it into like all year covered deck area. And we actually made that into a 3rd bedroom. So I'm gonna run it as a 3-bed, 3-bath. We purchased it for $433,500. That was inclusive of the furniture. So the property in its first year did over $80,000 in revenue. In our first year, we did about 70% occupancy with I think 325 or so average daily rate, maps to over $80,000 in revenue, which our mortgage, so let's just pull this open. It was, like I said, a 20-year amortization schedule, 3.7% interest rate. So in that first year, did some pretty good cash flow. We did pay our partners, the ones who managed the deal, took a management fee, the ones who operated the property, which I oftentimes do, but in this case, my partners managed it. They took a 20% management fee. So after that, I'm gonna adjust these OpEx. So after the management fee, as well as the mortgage payment, which was about $2,000 a month, we were doing about, over $1,000 a month of cash flow, which represented, in our initial year, our first year, pretty decent 12% cash on cash return. So that first year, it was doing great. We were cash flowing. That second year, I believe our ADR shot down into, 260 range, 270 we're doing about. Second year, so this 2023, we're doing a little bit over 70,000 in revenue for the year. So we were still cash flow positive, but not to the level of the prior year. So 2023, I believe we did about 75,000 revenue. We were still profitable, not as good as the year prior. But really, the calculation that we did and where we saw concern was that if we were going to do a refinance, we would likely be cash flow negative. So I'm just going to show you how we did that calculation. So we took out 20% down, which means initially we owed $347,000 worth of debt. So that loan amount, $347,000, was a 20-year loan, 3.7%. So that means after 5 years, we would have owed $282,000. So if our loan amount was now $282,000 and term was reset to 20 years, and now let's say it was a 7% loan, then our mortgage payment would have gone up. So whereas before it was a $2,000 a month mortgage payment, now is a $2,200 a month mortgage payment. So again, if we were to go into the refi, change this out to 7%, we would have been cash flow negative. I hope you found those numbers helpful. So now, what do I look for today and think about when buying in order to not run into maybe some of those same issues? First of all, I love 30-year fixed rate mortgages. I really try to stay away from any, balloon products or things like that. I am now in the business of also looking for unicorn properties. I look for unique properties that aren't going to be subject to the same rules of supply and demand like that 2-bedroom cabin. And no, this doesn't just mean being a massive property. It can mean other things like being a property near a city that can become a wellness getaway. So it's close to the city, but in nature. It can be a property in a city that has a massive fenced-in yard that you can turn into an experience for guests. In short, I want things that are unique, that can't be recreated. I'm looking for unicorns. So make sure you do what's not hard, but what's actually rather easy, and subscribe to my page, as I'll keep posting to help you crush it in business, real estate, and short-term rentals.